350,000. That is the estimated number of Turkish Americans today. And if you're one of them, you likely have one foot in each country, managing businesses, careers, and family properties to the Bosphorus. A lot of people assume that because the United States and Turkey signed an income tax treaty back in 1996, they are automatically protected from being taxed twice on the same money. To be fair, the treaty does handle some basics well. It sets up clear rules to determine where you officially reside, and it caps how much either government can withhold on things like dividends. It also sets up foreign tax credits. If you're a salaried expat working in Istanbul, those credits usually do their job and shield your basic paycheck from getting hit by both the IRS and the Turkish government. But that baseline protection is deceiving. It creates a false sense of security that masks structural gaps for anyone holding complex investments or foreign entities. The problem starts right here, in Article 1, Paragraph 3 of the treaty. It's called the Saving Clause. In plain English, this clause gives the United States the legal right to tax its citizens and residents exactly as if this treaty didn't exist at all. While you might expect a tax treaty to lower your tax bill, the Saving Clause strips away a huge portion of that double taxation relief for U.S. citizens. But the Saving Clause is only half the danger. The other half comes from what was left out of their bilateral agreements entirely. There are three massive blind spots. When it comes to transferring wealth to your kids, saving for retirement, or running a business, you are essentially flying blind in a hostile, no-treaty environment. The first missing piece is a Social Security totalization agreement. The U.S. has these agreements with roughly 30 other countries to prevent dual Social Security taxes, but Turkey isn't one of them. This chart shows exactly what that means for a cross-border entrepreneur. If you're self-employed, Turkey's SGK contribution of nearly 30% combines with the U.S. FATCA tax of 15.3%. You're looking at a total exposure approaching 45% of your earned income, and you can't use standard foreign tax credits to fix this, because the IRS classifies Turkish SGK payments as Social Security. The credit bounces right off. That 45% burden stays intact. Expats in Germany or the UK don't pay this, because their treaties prevent it. Turkish American business owners, however, are penalized simply for operating in both countries. The second gap impacts anyone trying to save for the future, using Turkey's private retirement system, known as BES accounts. The U.S.-Turkey Treaty was signed in 1996, 7 years before the BES system even existed. If you look at Article 18, the language covering private pensions is incredibly generic. It fails to provide the specific protections for defined contribution accounts found in modern treaties. Because of that missing language, the IRS often looks at a standard BES account and classifies it as a foreign grantor trust filled with passive foreign investment companies, or PFICs. That classification is a compliance nightmare. It strips away your tax deferral, triggers heavy excess distribution taxes, and forces you to file highly complex IRS paperwork every single year. What is designed to be a responsible, tax-advantaged retirement strategy in Turkey transforms into a heavily taxed liability the moment it hits your U.S. tax return. The third and final gap hits your family's estate planning. There is zero estate and gift tax treaty between the U.S. and Turkey. This diagram shows the scale of the problem. A U.S. citizen currently gets a $12.92 million exemption from federal estate taxes. But if a non-resident Turkish national dies holding U.S.-based assets, that exemption drops to just $60,000. Everything above that gets taxed. And the danger flows in the other direction too, especially if you're a U.S. citizen inheriting family real estate back in Turkey. Turkey has a rule where if you hold property for more than 5 years, you pay zero capital gains tax when you sell it. That sounds great, until you realize that paying zero tax in Turkey means you generate zero foreign tax credits to offset your U.S. taxes. The IRS will demand the full capital gains tax on that sale. Without an estate treaty to clearly split up taxing rates, holding properties across borders leaves your family's wealth uniquely exposed to double taxation and these zero credit traps. You might be thinking that as long as your money stays in Turkey, the IRS won't find out. That is no longer true. This data flow shows the reality of the 2015 FATCA agreement. Major Turkish banks are actively identifying U.S.-connected accounts. Your balances, interest, and dividends are collected by the Turkish Revenue Administration and automatically handed over to the IRS. We are already seeing the enforcement. In a recent federal case, United States versus Sidom, a naturalized citizen was hit with over $400,000 in penalties for failing to report his Turkish bank accounts. The most critical detail of that case is how he was penalized. He used a domestic tax preparer who never asked about foreign accounts, and they checked no on his tax return. The court ruled that checking no on Schedule B while failing to investigate your own foreign account obligations constitutes willful blindness. This is especially risky in Turkey. With the extreme volatility of the Turkish lira, an account might seem too small to report, only to spike over the $10,000 reporting threshold during a mid-year currency swing. The bottom line is clear. Not knowing the intricacies of international tax law provides zero defense in federal court. This matrix shows how we need to map these treaty gaps against your actual financial footprint to figure out where you stand. If you are a salaried expat, you're relatively safe. You can use the foreign earned income exclusion. Your main task is actively managing your foreign tax credits, because Turkey's 40% top tax rate outpaces the US top rate of 37%. If you are an entrepreneur, you face the highest structural penalty. You have to aggressively price that 45% uncredited dual Social Security burden directly into your business model. And if you are a retiree or investor, you have to do some hard math. You need to calculate whether the extreme accounting costs of filing the proper IRS forms for your BES accounts and inherited real estate outweigh the actual returns you're getting. Your specific cross-border activity dictates whether you face a manageable paperwork hurdle or a risk that can dismantle your net worth. We know that recent data sharing agreements between the IRS and immigration agencies have created a chilling effect. A lot of mixed status families are paralyzed by the fear that trying to fix past tax mistakes will draw unwanted federal attention. Doing nothing is statistically the most dangerous choice you can make. If your past omissions were honest mistakes, there are formal remediation pathways, like the IRS streamlined filing compliance procedures, designed specifically to get you caught up without devastating penalties. Do not let the mere existence of a tax treaty lull you into financial complacency. Move past the idea of simple tax optimization. This situation requires a strategy for compliance survival. You need specialized cross-border counsel who understand what the treaty protects and precisely where the safety ends.